Welcome to Target Market Insights, the Multifamily and Marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights, the Multifamily and Marketing Show. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. Now, if you're enjoying this show, do me one quick favor and leave us that 5-star rating and review. And don't forget to hit the subscribe button so you don't miss an episode. Now, today we got a good one. We're going to be talking to Mark Willis. Mark Willis is a man on a mission to help you think differently about your money, your economy, and your future. After graduating with 6 figures of student loan debt and discovering a way to turn his debt into real wealth as he watched everybody else lose their retirement savings back in 2008, he knew that he needed to find a more predictable way to meet his financial objectives and those of his clients. Mark is a certified financial planner, a 3-time #1 best-selling author, and the owner of Lake Growth Financial Services, a financial firm in Chicago, Illinois. Over the years, he has helped hundreds of his clients take back control of their financial future and build their businesses with proven tax-efficient financial solutions. Let's welcome to the show, Mark Willis.
Hey, thanks, John, for having me.
Thanks, Mark. You got a little tripped up reading your bio, man. I was sitting there just working through things in my head. I was like, man, it's a lot of stuff this guy's done. But I'll keep it high level. Why don't you take a minute or two and fill in some of those gaps there for us?
Well, you certainly covered quite a bit, so I won't bore your listeners with more about me. The real truth of the matter is we're living in very, very uncertain times, and the world continues to throw new information into our news feeds and misinformation, I would say, into our news feeds, which has a part to play with our financial life. Unfortunately, when one person sneezes on another, that can impact your financial future. That's how fragile the average American's retirement plan really is. And of course, my heart and my prayers go out to anybody who's been medically impacted or financially impacted by this terrible virus, which sounds like we're finally, John, getting some good news out of this thing with vaccines on the near horizon and more. But the truth is, we've been through crisis like this before. I personally went through 2008. I went through it on a income level. We graduated from our degrees, my wife and I, in 2008 with no jobs in the midst of the Great Recession, watching people lose half their life savings. And we had a mountain of student loan debt that we couldn't tackle. And it felt like a mortgage payment. Or, I kind of jokingly say I married 2 women in college, my beautiful wife, and Sally Mae was along for the ride. And Sally Mae wanted that monthly payment every single month. And I was trying to invest in my future, but I had my past to deal with. So that's sort of where things began for my wife and I. But a lot of our clients and a lot of our listeners on my podcast have told me, Mark, I'm sick and tired of this once every couple of years black swan that mangles up my retirement plans. It's just not worth it to them anymore to play the old game. And so that's why we at our firm, Lake Growth Financial, call ourselves not your average financial planners.
Yeah, Mark, you just hit on something just so close to home for a lot of people, right? These things just tend to happen. You call them black swan events, and whether it's every 7 years, every 10 years, but whatever it is, it's things that we just can't seem to predict, right? The
Right.
financial service industry collapses, the auto industry collapses. Now we've got coronavirus just come out of nowhere and just, really completely erasing a lot of the growth that we've seen, leaving a lot of instability in the marketplace. And you hit on it, man. Ultimately, what do we do to protect ourselves from these disasters, economic disasters, whether they're naturally caused or whatever else? There's got to be a way to insulate ourselves. So what are your thoughts there? What are some of the things that we can do to protect ourselves from all these things that we actually don't have control over?
Well, you're exactly right. We have to find a way to antivirus our money, to pardon the phrase there. But we have to find a way to pandemic-proof our cash and to build immunity to the next crisis. I would propose that we were already financially sick well before 2020 rolled around. We were in debt up to our eyeballs as a country and as the average family, and we had no game plan for weathering a rainy day. But what we got with this virus was a torrential downpour. So if I may, before I get to our ways to antivirus our money, let's talk about the virus itself, not the coronavirus. We'll leave that to the medical professionals, John, but let's talk about 3 spike proteins of the average financial thinking. Okay. The problems, I'll say, with the average financial thoughts that I hear when I just sort of hear average advice thrown about, or I hear kind of average financial advisors talk about people's financial plans going forward. So if you don't mind, maybe I'll jump into that and then we'll talk about some ways to build some financial immunity. What do you think?
Absolutely. I think that's a great call.
All right, right on. Cool. So my first issue and my first big problem I see, the big issue I see with traditional or average financial planning is that we have conflated this idea of saving and investing. So, we could handle market volatility if we had a massive amount of cash on hand, ready to go. If you're a syndicator, if you're a multifamily investor, and you had if you had known in 2019 that we'd be in rent moratoriums and other major problems in the real estate space, it probably would have behooved you to set aside a big pile of capital for just such an emergency. If you could go back in time and tell yourself in 2019 that this was happening this year right now as we're talking, what would you have done? Maybe packed away a ton of cash. But the problem is not really that we don't have the problem is not so much investing and that we have these regular financial crises like 2008 and 2020 and 2001. The problem is we don't have enough cash set aside for that rainy day, not just for emergencies, John, but also for opportunities. When you see that awesome, sweet multifamily deal come down the pipe, you're only able to take advantage of it if you've got the cash to throw at it, to lock down that deal with to come to closing with cash, as it were. So we didn't have a rainy day fund, and we got that torrential downpour. And in fact, as of 2019, our average savings rate was only 5%. And that was supposed to cover our kids' college funds, our flat tires, our medical emergencies, our job loss, and our retirement combined, according to the U.S. Commerce Bureau. John, do you think 5% of our income saved could really handle all of that?
Not even coming close.
Yeah. I mean, we got a nice spike in savings as the government was handing out money in the early part of this year, went up to like 28%, and then it has since dropped down again to about 10%. And I expect that'll drop back down to our average of 5%. But guess what? Our average debt load, the volume of interest that we service as an average for this country, again, same U.S. Commerce Bureau reporting as of 2019 was 36% of our income goes to service debts. So, with that in mind, that means a third of our day is just spent as slaves to a bank. If time is money, and if on the averages we're spending a 36% of our income on servicing debt, that's literally a third of our waking hours just gone. And then throw taxes on top of that, we really are working for somebody else rather than ourselves. Even if our name is on, if owner founder is on the business card, you're still working for somebody else called a bank or the IRS. So that's the first problem. We don't have enough cash saved. Second spike protein in the issue I see with average financial planning is that we get flawed advice from average financial planners. The average financial planner will tell you that over the last 120 years, the stock market has averaged, that's a key word there, has averaged roughly 10% a year. So that sounds pretty good. Sign me up for that, right? But over the last 30 years, real investor returns, according to third-party research, the real returns of actual market investors is closer to 3.5%.
Wow.
Yeah. Now, if I had asked you like, hey, John, what's an appropriate, acceptable return to deal with all the hoo-ha that goes on Wall Street, what would you be like? Some people would say 10%. Some people might say 7%, 5% at the bare minimum. No, the real actual investor results before taxes is 3.5% in the stock market over 30 years.
Why from 10% down to 3.5%?
Let me answer that with a story, and then I think it'll make sense. The quick answer is beta, but let me go into a quick story. Imagine, are you married or single?
I am married.
Married. So let's say the wife says, all right, hey, John, before you head home, I need you to pick up the kids at soccer practice. I need you to go across town and get some milk at the grocery store. Then I need you to go back across town and drop off the dry cleaning and then come on back home before dinner. Would that cost you more fuel than just to go straight home directly?
Absolutely.
Yeah, it's that back and forth that costs all that energy and volatility, right? And the same is true with our market portfolio. The average return is 10%. But your return, my return, anybody who's actually got dollars in has to have those dollars going up and down every single day in the market. And that beta, that volatility, means we get less than the average. I'll give you a quick math example and then I'll hush about this. Let's say you got 10 grand and you invest with me and I put that money in the market and 10 grand doubles to 20 grand. That's 100% return in 1 year. Feeling good so far, right? So you would reinvest with me the next year. You start with your 20 grand and this year I lose half your life savings, negative 50%. So we went from 10 grand to 20 grand, back down to 10 grand again. Okay. So how much more money do you have after 2 years?
Nothing.
Zero, right? Yeah. Same amount you started with. But if you did the average return, 100 minus 50 divided by 2 is a positive average. I could quote on my brochure that I gave you an average return of 25%.
Wow.
Yeah. And mutual funds are allowed to advertise. Speaking of marketing, talk about great marketing. Maybe it's misleading. I would say it is, but that's literally what mutual funds are allowed to advertise. So the average investor is only doing 3.5%. That's my second spike protein on the virus of average financial planning.
So Mark, that's called beta. And just to play it back, you're saying that a lot of these big banks, these institutions, they can say, even if they make me money 1 year, lose money the next year, they can average it out and communicate the average return, even though the net is zero.
Correct. Yeah, the best performing mutual fund over the last decade had an 18% yearly return, but the actual investors in that same fund, John, lost an average of 11% per year.
Wow.
Same reason, because we buy, sell at the wrong time, and because averages mean nothing when it comes to your actual cash on hand. The real thing we want to look for is something called compound annual growth rate, which I won't bore your listeners with. But the point is, Wall Street is designed and marketing their products in a way that's obviously misleading. If we're expecting to get 10% and we don't get even half that, that's a problem for most people's retirement plans.
And Mark, I actually thought you were going to talk about just the fees that are involved, right? Because, obviously you have a lot of fees from people who are managing your accounts, and there's a fee every time you trade or do something like that. So I actually thought that was the reason it was going to eat so much into it. And you're saying that it's really this beta. How much does the fees come into play as well?
Yeah, according to Department of Labor, if you have a fee of an average of just 1%, and by the way, if you think you don't have a 1% fee, if you total up all your load costs on your mutual funds, 12B1 fees, wrap account fees, add them all up, they're often not visible when you just look at your account statement. But the average IRA has a 1.7% fee. So let's just take it at 1%. Let's just make sure we get those low cost index funds in there and everything else. Let's say your average fee is 1% per year. According to Department of Labor, if you have a fee of just 1% on your money every year, doesn't sound like a lot, John, right? But even just a 1% fee can vaporize 35% of your money over a 30-year period, according to Department of Labor. So that's a third of your money gone just to fees. And that is included in that Delbar number I quoted you earlier, by the way.
Man, that's crazy.
3.5%.
That's crazy. Wow. Well, thank you for clarifying that, right? So
sure.
Obviously a lot of things here to take our money away.
Yeah.
And, obviously we got to figure out some ways to insulate it. So you started talking about, did we get to the third, what would you call it? Spike?
Yeah, spike protein. That's just my silly, nerdy way of talking in terms of the financial virus in our portfolio. So the third major thing, and I'll keep this very brief, is there's a fallacy out there in traditional advice called buy and hold. if you've listened to CNBC or any of these other kind of talking head networks, you're going to hear people talk about just buy, hold, don't look at it when it's dropping. Don't open your 401k when the market crashes. I mean, honestly, John, it really sounds a lot like the same way we talk about abusive relationships. I hate to say it this way, this starkly, but the more I hear people describe the stock market and your response to its abuse, it really does sound like the same way we talk about abusive relationships. Don't look at it when it's hurting you. It'll always come back. It's your fault that you're in this position. I mean, these sort of things shouldn't be your relationship with money, should not be an abusive relationship. So the problem I have with buy and hold is that, again, every year of volatility vaporizes that chance to really meet your goals. If you get 10% in the first year, you get 10% in the second year, you've got an average return. In the third year, you get another 10% of annual returns. That's an average return of 10%, and you're feeling great. But 1 year of negative 10%, okay, so in year 4 now, we've had 3 years of positive 10% growth in the market, and just 1 down year of negative 10%. Your 4-year average goes from 10% to 5%, just because of 1 down year. And not even that bad, right? Negative 10%, we could do that any given Tuesday in the stock market these days. So, the buy and hold fallacy is, just hold on. It'll always come back. You can never get back what you lost. That's the problem with volatility. That's the third problem I see with traditional financial plans.
No, man. Hey, listen, I think you just gave some really great insights for people like myself who I don't spend a whole lot of time in the stock market world for a lot of the reasons you've already discussed.
Preaching to the
But
choir.
for those, but it's good to understand, right? I mean, for me, part of it is working in corporate America, understand the way companies work, the way they think, the way they, run towards those quarterly reports. And it just didn't seem as sustainable for me. And I like businesses that focus more on solving their challenges and not manipulating numbers necessarily. With all that said, I think for anyone who is in the stock market, maybe it gives them a reason to step back, take a look at their actual returns, get a sense of, what's actually going on, and figure out how they get more control over their money. With that said, Mark, let's talk about the way forward, right? So recognizing that the stock market has its flaws, your average financial advisors are going to give you some of the advice that we just debunked. What exactly should we be doing with our money?
Yeah. So let's talk about function over labels. And then we will get to some labels, products, strategies that we recommend to our clients. But let's start with how to antivirus your money. We need it to have 4 characteristics. And I'll mention them quickly. We need fluids, quarantine, antibodies, and supplements. Those are the 4 ways to be financially immune to the next crisis. Because let's be honest, John, we've had 3 major market crashes just since the year 2000. Do you think we're done over our lifetime? Do you think we're done with these financial mayhems that seem to come up every couple of years?
If I were a betting man, I would say they're going to keep coming.
Yeah. So build ready now your immunity. Build that immune system up for the next time. So why do I say fluids? Fluids, we need lots of fluidity. We need liquids to lower our temperature in our bodies when we're sick. You drink a lot of liquids and you feel better. Same is true when your money is sick. You need ready access to capital to fight back when there's an emergency, like we've gone through some of us this year, or opportunities when things are going well. So we need liquid capital. We need our money accessible. 401ks, IRAs, our house are all illiquid assets. Okay, so number 2, we need quarantine in our cash. This means we need to get non-correlated assets. That's a $2 cocktail term, John. So what that means is we're putting some of our money in this basket and some of our money, not just in another basket, but on another truck. If all of my money is in 12 baskets and I'm feeling nice and diversified, but then all those baskets are on the same truck and that truck goes over a cliff, what good did that do us, right? So we need a non-correlated asset. That's what I mean when I say quarantine. Put some of your money on various non-correlated assets, other trucks, so to speak. Third, we need antibodies. When I work out, when you and I go to the gym, whatever, we're destroying our body. If you can imagine, we're ripping up cells, getting rid of the weak stuff, putting stronger parts in place. And when I get sick, my body actually learns from that sickness. It creates a new intelligence that protects me from similar threats in the future. So, we're waiting for this vaccine. When the virus is inflicting our world, we wait for that vaccine. It's a source. In some ways, they're creating a fake virus inside your body to teach your body how to prepare for such an invader. And, the truth is, we don't have to go through the pain of market loss. We can learn from those who have gone before us, those who have the antibodies of market loss. So, if you were fortunate enough to avoid the earlier crashes of 2020 this spring or 2008, you can learn. It means putting your money in places that you have learned are resilient to market calamity. If we keep doing the same thing over and over again with our money, they call that insanity. So building some antibodies means learning not just to survive the next financial pandemic, but actually to become stronger as a result. It's the old technical term is hormesis, where you actually, when pressure is applied, you get stronger, not weaker. Fragile systems break, but hormetic systems or anti-fragile systems get stronger. And so are you building a financial plan that is resilient and even thrives on market chaos and calamity? So the last piece is supplements. We need to build something into our portfolio that works well with the rest of our financial life. John, I'd say too many people I meet have all their money in all these different buckets. They have their college account for their kids. They have their 401k. They have their fund brokerage account that they had with their brother-in-law. They have their house paid off or close to it. They have their syndication deals and their other real estate projects that they're working on. And it's in their savings accounts. It's all spread around in a way that cannot help itself. They are all locked up. Okay. And what I'd like to suppose and suggest to become financially immune is to make sure that one part of your financial life builds and bonds with the other goals that you have in your life. Make all of your money be the hinge on your financial door. Why should your money fight with itself? If I've got a 12% mutual fund in my 401k, but I got credit cards at 28%, what sense does that make? Right? If I've got my pre-tax 401k earning me 12%, I feel great. I had a guy who was a doctor making a great deal of income and was very happy with his mutual funds in his 401k, doing like whatever 12% last year. But then he had all this debt on boats, mortgages, credit cards, student loans, equaling almost a third of his income. So I don't care what your mutual funds are giving you. If your guaranteed negative return on all your debt is 30-something% of your after-tax income, that's a losing proposition. So we need to find ways to supplement our financial life, get our money working cohesively, not against itself. Those are the 4 elements, and we can get into practicals on how to do that if you'd like.
Yeah, no, listen, I love that. Just to recap real quick, you talked about the 4 elements, right? Fluidity, quarantine, antibodies, and supplements. And as you were talking, I was going to ask the question about supplements and quarantine because it appeared to almost conflict, right? Because
right.
As you started talking about it, it was quarantine having things that are on different trains, just really completely separate vehicles. But then we talk about supplementing, making sure everything worked together. I was trying to figure out where you were going with it, but it sounds like it's more about understanding the debt side of our finances and making sure that, yes, you can have money in an IRA account and a 529 or whatever, but if you have those funds there and you're bleeding money through debt, you're really not building in the way that you are hoping to build. But maybe you can elaborate or clarify.
I'll be brief, but I was driving down the highway one time. You may have had this experience. Maybe some of your listeners have, where I'm just driving down the highway and all of a sudden I see this Humvee blow right by me. And then about 30 seconds later, like another kind of military looking vehicle follows right behind the Humvee. and then another, and then another, and then like a tanker or something goes by, and then like a flatbed with a bunch of other really cool four-wheelers, military grade, camouflage four-wheelers go blowing right by me. Are they at odds with each other because they're in different vehicles? No, they're a part of a train. They are part of a cohesive unit. The geese flying south right now for the winter, they're 15 different geese, but they're rotating in and out of who's in the lead. One of them's getting beat up by the bugs and the wind at the front of that V formation, but they're constantly rotating who's in the front, and they're working together as a pack. So even if one goose gets shot or falls out of the sky, the rest of them will still make it to their destination. That's what I mean by supplements. They're coordinating and working together, not fighting against each other, like too many financial lives I see with people. But it's still important to keep your assets in different places. And that's what I mean by quarantine.
No, I appreciate that clarity. That really helps us. So let's talk about, some of the steps, right? So this is very helpful for us to understand what we can do to, what do you call it?
Antivirus your money. Yeah.
Antivirus.
Yeah.
Antivirus our money, right? So as we look to build out, right? And I know folks work with CPAs and different folks. I see these names and titles all the time, and honestly, it's confusing to most people. I don't know the difference between so I shouldn't say I don't, but a lot of folks don't know the difference between an accountant, a CPA, a financial planner, a certified financial planner. Can you, one, help us understand kind of this log jam of titles? And then two, what should we be looking for as we try to get the right financial strategy for our own lives and our families?
Yeah, it's all about, what do you want your money to do for you? I can't answer that on a podcast or video. I really don't have everyone's financial life in mind. I can ask you to consider, what characteristics or attributes do you want your money to have? Because where you put your money makes it act different. A hedge fund is different than a savings account. A syndication deal is different than, a single family home, or an annuity, or a private fund, or a brokerage account. So asking yourself about the attribute. That's why I focus most of our talk today about those attributes, quarantine, supplements, liquidity, and so forth. To me and for me, in the midst of this pandemic, it's been extremely valuable for me to have liquid access to my money, where it grows guaranteed every single year. I can access it without any taxes due on the cash at any time. And I can even use it as a source of leverage for all of my opportunities, business investments, real estate, and more. I use a form of high cash value, dividend paying whole life insurance to accomplish that myself. And it's not the kind of whole life insurance that you hear about on the radio, Dave Ramsey, Susie Orman. This is a modernized form of cash value life insurance that allows us to antivirus our money. It builds liquidity. It builds a non-correlated asset outside of the stock market that grows guaranteed every single year. It allows me to participate like a banker for my real estate deals. I'll give you a quick story. We had a client who's been packing money into his policy for years now, and he had a deal was going to ask him for about $400,000. So he borrows from his life insurance policy, dumps that $400,000 into the investment, the real estate deal. And John, this is crazy, but the policy will continue to build interest guaranteed and dividends as if there was no loan against the policy. So let that sink in for a minute. He's got liquid cash, pandemic-proofed his money, antivirused his money. It's guaranteed to grow for him. He has access to it when banks stop lending. He borrows and accesses within 3 to 5 business days. He gets $400,000 deposited into his bank account. He comes to closing with cash. And now he's got his real estate deal generating cash flow. He's got the appreciation of the real estate. He's got the tax advantages of the real estate. And yet his policy is still paying him on the entire $400,000 as if he had never touched a dime of the money. Not to mention a death benefit for his family in the order of $1 million+ bucks. So that's a powerful way to not just, again, antibodies, right? Not just survive this financially turbulent time, but actually become stronger as a result. Here's what I mean. Let's say that banks stop lending. They're pretty good at doing that during tough times. What's that old quote by Mark Twain? A banker is a fellow who will lend you his umbrella when the sun shines, but wants it back as soon as it starts to rain. So when banks stop lending again, who's going to be the one that can take down these great deals? Is it going to be people who are dependent on generous bankers to continually offer those lines of credit? No. When are banks least likely going to give us lines of credit? During an emergency, during a crisis. When are we most likely going to need access to capital? During a crisis. But it's the guy like my client and myself and so many of our other clients that we work with around the country that have ready access to contingency capital for their deals, where they can come to closing with cash and they borrow from their policies and still get growth on the money as if it wasn't taken out of the policy. That to me is truly becoming anti-fragile or even stronger as a result of turbulent times.
No, Mark, that's powerful right there. Just understanding the value and the access to capital that we can create for ourselves. And this is a concept that you may have heard of other people talk about even on the show, but this is something that you should certainly learn more about, because if you can tap into getting a high cash value policy that you can tap into and use it in the way you're talking about, the doors just open up for you, and you insulate yourself from a lot of the things that's happening around the world. You control your own destiny. Mark, we're running out of time here, but for folks who want to learn more about that unique strategy, is there a resource or a website that they can go to learn more?
I would say just be aware it's not for everybody. There are front-loaded insurance costs in the first few years. That means you lose some purchasing power in the short term. So don't do this for overnight wealth. And it's also a regular savings bucket. So you want to make sure that you're ready for that kind of at least a several year commitment to it. I would say it's a lot like a real estate deal that takes a few years, and there's usually upfront costs to real estate as well. But do your own research and be aware there are a lot of, I'll call them YouTube advisors or Instagram advisors out there who don't have any sort of credential to this. There is no official credential except one in this space. There's 400 life insurance agents in this country, 400,000. That means one for every 800 Americans. And not every one of them knows about this, certainly not. In fact, even the ones that have read a book or two on it can mess up a policy that's designed incorrectly. It can lose a lot of the tax advantages. It can grow a lot slower. I've seen all sorts of mess, unfortunately, in this space. So that's why me and my advisors became Bank on Yourself professionals. That's the only credential in this space of using life insurance as an asset that I'm aware of. So go find anybody who calls themselves a Bank on Yourself professional will do right by you to design this policy and mentor you as you go through life using it well. If you want to work with me or one of my top advisors in my firm, you can go to Not Your Average Financial Podcast. We kept the website nice and short for everybody. NotYourAverageFinancialPodcast.com. And just click on Request a Meeting. We'll happily chat with you for 15 minutes. That's NotYourAverageFinancialPodcast.com. Just click on Request a Meeting.
All right, Mark, we're going to go to our bullseye round. You ready?
Let's do this.
All right, Mark, give me a failure or an apparent failure that set you up for later success.
Paying off my debt the old-fashioned way was a huge mistake. Early 20s money is the most valuable money you'll ever have, so don't throw it at low-interest debt if you can help it.
Give me a digital or mobile resource you recommend for your business.
For my business, I just think the productivity apps like Trello and some of these others out there are just absolutely game-changing. I'm having a lot of fun. And podcasting. Come on, the podcast app on your phone is revolutionary.
Give me the book you've recommended or gifted the most in the last year.
I think one of them is The Best Bet for a Secure Retirement. It's about how to get paid for the rest of your life and never run out of money or income as long as you live.
Give me a daily habit that helps you stay focused on your goals.
The full focus planner right here. Write those goals down every day. Remind yourself of what you're getting up in the morning for and go after it and crush it. If you can beat the sun up every day, write down your goals. You'll have a lot of fun.
What's one thing you know now that you wish you knew when you were starting out?
Math. Math. I was not a financial advisor in training in college, and I just assumed that financial infotainers knew math, but they do not.
What are you curious about right now?
I think the best thing I can say is, what are your principles? What are my principles? What do I believe stands the test of time from multiple angles? If I could come up with like a list of 25 principles to hand to my daughter someday, I'd feel like that'd be a pretty good life.
And Mark, you're in Chicago, right?
Yes, just outside.
All right. So Chicago, great place. We know it well. Spent a lot of time there. Give me your best place to grab a bite to eat.
Man, it feels like a century ago when I was going out to eat much. Burger Bar, North and Clybourne area. Beautiful, awesome burgers. Probably 50 kinds of meat and as many kinds of beer. Great meals and great entertainment too.
Burger Bar, one of our favorites. Great recommendation there. Mark, lots of great information, man. I love the way you broke down what really need to understand from a financial standpoint. Thinking about really how do we, what did you call it?
Antivirus your money. Yeah.
Antivirus your money. I'm going to get it right. How to antivirus your money. Lots of great tips there and really just helping us understand what's really going on in the stock market. I think many people recognize that something's not quite right, but really starting to understand what the returns truly are and what happens on a daily basis, I think is eye-opening for some people there. You've given us your website. It's the not your average financial podcast.com. So you can check that out, learn more about what you have going on, and schedule a call. And subscribe to the podcast too. Lots of great information on that show. So make sure you check it out if you want to learn more about this. And Mark, the last thing you said was making sure if you are interested in tapping into the life insurance policy strategies, it's really about, the bank on yourself, right? So making sure that you have a bank on yourself professional, which Mark is, but make sure you are learning more about this. If you're interested, reach out to Mark and his team to learn more about it. Mark, anything else before we wrap today?
No, you're doing a great job, man. Keep up the great work.
Thank you, Mark. Listen, it's been a pleasure talking to you. Thank you for being a guest on Target Market Insights, the Multifamily and Marketing Show.